Well, I have to admit this is the first time for me. Today's trade idea segment didn't make it into the video tonight. So technical errors here, but we figured it out. At least I figured out what's going on. I still have the segment, so that's what I want to share with you tonight. So tonight you get two market outlook videos for the price of one. So as always, thank you very much for watching, and we'll see you all tomorrow. For the trade idea of the day, I do want to take a look at a stock that really kind of fell out. You can see Celgene in the news to the downside again. You know, like I said, market posture is still bullish. It's not strongly bullish, but it's working its way. Yeah, we've had a little bit of a pullback. Again, just a good reminder on days like today that we don't want to be too heavily one-sided. All of our trades in our active portfolio are bullish. Not obviously, we don't want them all to be bearish either. We want to have a good balance. When you got a bullish posture, you have to be really picky about the kind of bearish trades you got. In this case, taking advantage of a news story coming out for Celgene, pushing it from a technical perspective off of its downward sloping moving average through its low point. So it's almost like it's trending down, and a lot of the downside move happened in one day instead of spreading out and being more gradual over multiple weeks. You can see its intermediate line turning down, momentum getting to an extreme low point, and near-term line pulling back with a lot of volume, obviously, when you have news stories like that. And when you see it too here on the Bollinger Band, you can see how we were pushing below the lower Bollinger Band, got back up to the falling exponential moving average in between, and then boom, right back below the lower Bollinger Band again. So bearish here, and you can see I've got a line drawn. There's a reason why that line's drawn there. In fact, I didn't draw that line. So what we're going to do is we're going to take a look at, again, we don't want to be aggressively bearish when we're not in a bear market, right? When the market's not in a bearish trend. We just want to have something higher probability, something that adds a little bit of negative delta to our portfolio, gives us high probability and a little bit of a balance, among other things, among other trades. So we say, okay, well, what if I look at selling that $90 call and buying the 95 call for protection in case it were to take back off to the upside? And well, you notice that delta is pretty high for what we normally look for in the mid-30s for that high probability strategy. But we're also getting some pretty decent credit. We're getting about $1.42, which usually we look for about $1.16 to get a 30% return on risk. And again, the goal isn't to get the highest credit possible. The goal is to get the highest probability possible. Otherwise, buy a put if you want to get the highest return possible. We want to get the highest probability possible without getting too little credit. And so what's the balance? 30% return on risk is the balance. And again, that tends to be about $1.16. In this case, we'll go for about $1.20 using a stop limit order, which means the stock has to go down some before it will get in. You notice we're at 87.12. It's bouncing up a little bit in the after hours, 87.42 to 87.60. It has to get down below 87 to 86.33 before it will get the price in the range where I'll get an acceptable credit to get that 30% return on risk and higher probabilities. And you notice that break-even level, when I put the break-even here, there's a pretty decent odds of success as it is, but when you add on the fact that we have to wait for it to go down before we get in, and you add on the fact that there's where your resistance is. Your break even is at, there's some, I probably would have drawn that line if I could have, because there's an old low point there. There's the top of the gap, the top of today's range there. So there's gonna be a gap there to fill in that's gonna act as resistance. So there's some resistance in this area that if we were to trade back up, first of all, I won't get filled in until it continues to go down. But even if we drop first, filled me in, and then traded back up, there's gonna be some resistance there, and we have to go through that resistance to get to right about in that area here, which would be about 92.25 to match on a loss basis, no matter what day it is, what I'm trying to get on a gain. So I get a 1-to-1 reward to risk ratio. So now we're looking at, you'd have to start getting into above today's high point and start getting into today's range. So it kind of shows you, we're going to make sure it continues to go down before we get filled in, and then when it does, we're going to use that resistance level in our favor to hold this thing down. It doesn't have to keep going down. That's the beauty of a higher probability strategy like selling calls. It doesn't have to go down significantly. It just has to stay down. In this case, it has to stay down below the $90 strike price, and we're, of course, we're already down to 87. So as long as it stays below 90, which is, with the break even close to today's high, then we have decent odds of success for this working out, considering the breakouts that we're seeing on the Bollinger Band basis, as well as on the market forecast and other indicators that we're seeing here.